Good morning, everyone. Now I am going to start the video on tax versus duty, direct tax versus indirect duty. Tax and duty are both form of financial obligations imposed by the government, but they different in their nature and applications. Additionally, direct and indirect taxes request two index categories of the taxation, each with its own characteristics. Its implications. Let's explore the difference between tax and duty as well as direct tax and indirect tax. First one, we will explain the tax versus duty. Tax is compulsory financial changes or levy imposed by the government on individual business or proprietaries. The tax are generally used to generate revenue for government expenditure and public service and then infrastructure, education, healthcare, and defense. Tax can be levied on various sources including the income, profit, property, and transactions and consumptions. For examples of tax include the income tax, corporate tax, property tax, sales tax, value added tax, and excise duty. The duty refers to the specific type of tax imposed on the import, export, production, consumption of goods and services. Duties are often used to regulate trade, support domestic industries, and generate revenue for the government. Common type of duties include the customs duty, traffics, excise duty, import duty, export duties, and consumption duties. Duty can vary based on the types of goods and services, their origin, or restrict their values of their quality. Description. Residential property owners can be also claim depreciation on the structure of the property over its useful life as allowed by the tax regulations in this can further deduction taxable income. For example, Amy wants an apartment building. The tax regulations show her to claim depreciation on the building at on the certain rate such year. She can include the depreciation expenses when calculating the tax income from the property. Limits on deductions. Tax laws may impose limits on certain deductions or specific eligibility criteria for claiming them. It is essential for property owners to understanding these rules to maximizing the tax benefits. For example, M residential property generates general retail income, but he can only deduct the portions of their mortgage interest because the property is not his primary residence. He needs to be aware their specific rules governing the mortgage interest deductions of the rental property. Depreciations. Residential property owner can also be claimed depreciation is of the structure of the property owner its useful life as allowed by tax regulations. This can further deduction taxable income. For example, Amy owns an apartment building. The tax regulations allow the claim depreciations. It is also not primary resident. He needs to allow of their specific rules of governing the mortgage interest deduction to the retail property. Then they will deduct all specific eligibility criteria for claiming them. It is essential for property owners to understand their rules to maximizing the profit benefits. For example, M residential property can be income but cannot direct portions of this mortgage interest become the property is not his primary residence. He needs to be aware of specific rules governing the mortgage interest deductions and rules of properties. The property generates the rental income but can be deduct with a portion of mortgage interest because the property is not his primary residence. He needs to be a make two specific rules to covering the mortgage interest, educate their retail property. These are the points included in the duties and taxes. Thank you for this video. Next, I will explain the next sessions.